Welcome back to watching Business Morning live on Channel Television. Let's head on to the commodities market now. A city benchmark index of international food commodity prices declined in January for the 10th consecutive month, according to the United Nations Food and Agriculture Organization. Let's talk to Tomi Maiwa now, analyst, financial director's company. Great to have you, Tomi. Morning.
Good morning. Thank you for having me, Ladi.
So it's the 10th consecutive monthly decline. Are we out of the woods yet?
Well, let me start by saying that prices actually declined. Global index price actually declined by about 18%, from its peak in March, and that's because of the we saw an increase, a spike in grain price as at the start of the Russia and Ukraine war, and then because the Black Sea region was blocked, we saw grain price actually skyrocket. But we saw a decline in moderation in grain prices, starting from where, the war, the Black Sea region deal was signed by Russia and Ukraine. And, we saw some supplies there. And then recently, we've seen increased supply from Russia and from Australia. So that has been actually supporting the markets at the meantime in the short term. And I think in the short term, we're still going to see that moderation in prices because Russia will still continue to, at the short term, we'll still see that increased supply from Russia and from Australia. But on the long term, the war is still, on, and we don't know when it's going to end at the meantime. And then Ukraine is still actually supplying below what it used to do supply before, and so that's a long-term risk. Also, the weather forecast, it's possible that weather may not, the weather conditions may not be favorable for future harvests. So those are long-term risks actually. But on the short term, we're still going to see a tapering in grain prices.
It's quite interesting that most commodities that saw new highs in 2022 seem to be on that downward trend in
yes,
2023.
For example,
but
we have wheat and then rice, corn, all of those actually feeding into that decline.
Well, let's hope that continues. But does this translate to lower food prices in Nigeria, and are there any risks ahead that could take global food prices up again?
Well, typically we should see that translate into lower prices in Nigeria. However, there are risks actually, considering the fact that last year we saw that the CBN could not supply forex to manufacturers as it used to do, probably 2021, about 40%, but now about manufacturers get about 18% of their request from the CBN now, and so they have to go to the parallel market to get the rest. And this is high risks because considering the fact that it's quite costly to get dollars from the parallel market, that's a high risk to prices in Nigeria. So what we're going to be seeing is that irrespective of the decline in global pricing, if the naira continue to remain under pressure, that would actually limit the impact of seeing that price. So manufacturers will continue to pricing their products based on the parallel markets.
All right.
And well, for risks in terms of global, like I mentioned earlier about the long-term risk, the war is still on, and so that will continue to keep price elevated, considering the fact that Ukraine is doing below what Ukraine is one of the top largest exporter of wheat, and so or other grain products, and considering the fact that they are still supplying less than what they should supply. So the market is still not fully supplied at the meantime. So that's a long-term risk.
I guess geopolitics, they are still on the front burner at this time. But let's look at the oil market now. See, oil prices have risen for a second straight day today. What's driving sentiment in the market right now?
Let me start by saying that I think about 3 months ago, we were talking about the zero COVID policy in China, and the fears of recession, all of that were actually leading to a bearish sentiment in the market. And, it was all bleak at that time. But now we've seen that China's economy is reopening. I think the International Energy Agency said that in 2023, China's demand will account for half of its supply in 2023. So and considering the fact that this reopening has led to an increase in flights, because the economy is reopening, they can move from one place to another. And also there's an increased demand. Don't forget that China is actually the second largest economy. So there's an increased demand for jet fuel because of the increase in traveling and all of that. So that is actually going to support demand in the even in the long term, considering the fact that zero COVID policy has been eliminated. And then there's been more optimism in the market, considering the fact, because we had seen that the recession that we were expecting was not really going to be as worse as we were expecting. So there's demand. The labor market is still tight in the US. So all of that are really still supporting the fact that there's still demand might remain resilient even in the long term.
And obviously, we still have everyone looking at that China demand to determine, where oil prices are going to go. But we also have LNG prices. That's trending up, at this point. Don't know if I can call it a trend yet. But how would this play into the disinflation narrative if these prices continue upward?
Like you said, it's because it rose to about $9 per MMBTU last year because of the outbreak of the war. Well, it's down by over 50%, and that has helped to actually reduce inflationary pressure, especially to the most exposed economy, which is the Europe. And so, well, I think the Europeans have actually been able to source for gas, natural gas from other alternative sources. The fact that Russia gas cuts has actually led to increased investment in other alternative sources. So I think that they've been able to look for alternative sources, although there are risks that the weather can be more cold. There are forecasts of cold weather, in the future. So, but it's I think they've been able to find alternative sources that can help them to support supply in the short term. So I think that might help to tame price increase in the short term. It might not go as high as what it was last year. So I think that's what we're going to see in 2023. So although we're going to inflation, it's if gas price actually increase significantly, then it will definitely raise the risk of inflation. There might be more, the inflationary pressure might increase again, and then the US Fed or the Bank of England might begin to tighten rates again at an higher pace, actually. But in the short term, we think that gas price will actually remain low short term.
And obviously, we know the global central bankers, all of them all ready to take rates even higher in 2023. But let's look at the Naira now. Even though the Naira has gained so much value, with us Nigerians, some people having to pay a lot to get cash from POS operators. But it's lost value to the dollar in the parallel market.
Well, let me start by saying there's a lot of uncertainties in the air. The deadline is supposed to be, or the deadline is on February 10th, and nobody knows if they're going to shift it or not. And so people just have to cover up and try to buy dollars somewhere. And that's one of the reasons why we are saying there's this fear, all of that we are saying that panic buying, or should I say demand pressure in the parallel markets. And also there's increased liquidity. Considering the fact that if you check the bank's opening position recently, we've been saying about 1 trillion opening position, 500 billion opening position, despite the fact that the CBN is tightening its monetary policy. It's raised its MPR by 100 basis points in its last meeting. And what we saw the next day was a sharp decline in its 1-year T-bill to about 4 points. That's quite far from what inflation is, which is about 21.34%. There's that the fact that the 1-year T-bill is not even attractive. So that's not even it's not helping him to mop up the liquidity in the system. So definitely, once you have excess liquidity, people would have to use, consider that the interest rate is not attractive. They just have to look for other means by investing in dollars and all that. I think that is actually fueling the buying sentiment in the parallel market, and also the depreciation that we're seeing.
But how's the cash scarcity? How's that impacting the domestic commodities market?
Well, what we've been seeing really now, it's price distortions, because if you have the new notes, you pay for the real price, and then if you're going to make a transfer, because you have to pay the POS when you want to withdraw, most retailers are actually pricing that into their commodity, especially when you want to pay transfer. So what we've been seeing is price distortions, and that's definitely not good in terms of allocating resources, because it's actually not good for a perfect market. And so that's what we're going to be saying. And then we don't even know the real price of what this is again, except, so it's really not comfortable for consumers. And the fact that their confidence is being eroded. You want to buy something and you cannot because you don't have cash. And so definitely what we even see again is a decline in aggregate demand. And if there's a decline in aggregate demand, the suppliers will not be able to supply the markets, because they don't want to have too much inventory in their stock. So all of that will definitely filter into the formal sector. So it's quite it has serious risks.
All right, let's hope everyone gets the cash they need this time, and we can also make transfers easily without any issues. Thank you so much, Oluwatomi Mayowa, Analyst, Financial Derivatives Company. Thank you.
Thank you very much, Lenny.